Okay, without further ado, let's get stuck in. So yeah, today's session week two, the topic covered in this class are investment objectives, the investment market and how it currently looks and how it's shaped, asset classes. So these are the different types of products that you can buy and hold as part of your investment strategy and investment life. So today we're looking specifically at three of them: money market, bonds, and shares. All this will be explained as we go along. And then finally, we're going to be exploring the investment process and how you can actually begin to get involved in these things. Learning outcomes: you will learn about the investment landscape, understand how the investment market works, and how it's segmented along various categories. And that's one thing that we really want to be able to break down to people, to let you know just how much there is available out there and all of it at your fingertips. And then finally, you will learn where to go and what tools to use to begin your investment journey. So yeah, investment objectives, time to invest. Why are you investing? That's always the first question to ask yourself. What is your goal? We all have different reasons for wanting to invest. Some of the common ones are we want to buy a house, we want to save for family, and want to leave a legacy behind of financial stability or economic well-being for our loved ones. So always have a goal in mind that will give you a target to work towards and make you more disciplined in your approach to investing. Next thing is to figure out what you're trying to achieve. Often at times people will say it's financial independence, but financial independence can look different to different people at different stages in their life. So when you're at university, financial independence might just making sure that you are able to buy your books and afford your upkeep. Financial independence, once you start a family, will be being able to provide for them adequately, and so on and so forth. So always know what you're trying to achieve, what the long-term plan is. And then also, finally, know over what period you're trying to achieve it. So usually in the investment world, you have short, medium, and long-term investment strategies. Short is usually 1 to 2 years. Medium is 2 to 5 years. And then long-term is you're getting upwards of 5, 10 years, that kind of thing. So know over what time horizon you want to invest and what you're trying to achieve in that period, because this will then shape your approach in terms of how much you're even saving monthly or investing monthly, and what your expected investment gain over that period will be. There's actually tools out there that can help you figure this out quite easily, and we can explore all this as we go along during this series. So the process of selection. The market is divided by, number one, geography. So when you're researching different investment products, what you will always see are the names, the product given names according to the region of or the territory where the investments are held, or the investments or the country where money's been invested into. So typically you will hear Asia, or Asia excluding Japan, Europe, Russia. EMEA is an acronym for Europe, Middle East, and Africa. So they're usually grouped together. And then you have North America, or the US, grouped together. And then you have Latin America separately. And then commonly you also have growth areas now, which go by the acronyms BRICS and MINT. BRIC stands for Brazil, Russia, India, and China. So these are like the next frontier markets, the next emerging territories where a lot of investment is being put into, because those countries are growing very quickly. And when a country grows quickly, it usually represents a good investment opportunity, and provides good returns. And then the next one is MINT. MINT stands for Mexico, Indonesia, Nigeria, and Turkey. So these are like the next basket of countries where people are expecting really good growth and seeing really good growth. The market is also divided by size. So we call this large cap, mid cap, and SMEs. Large cap is basically your biggest conglomerates, your biggest international companies, So think about your Microsoft, your Apple, your Google, McDonald's, those kind of companies. Then your mid cap and the next tier down. These have some international exposure, but they may not work in every region. So this could be usually like mining companies, uh, consumer goods, consumer staples, engineering firms, and then you have SMEs. These are your small medium enterprises, which are still relatively young in their development stage. The market is also further divided by asset class. So that's what we mentioned earlier. Typically, you get quite a nice spectrum of different assets. So an asset is simply the type of product that you can invest in with the expectation that you make a return on the money that you invest. One of this is money market. We'll explore that in detail. Bonds is the next one. Bonds are a form of IOU. So this is where, for example, if I wanted to borrow money off my mum, I'll go to her, and usually maybe mums will just give me the money, but in an investment sense, she will need to write a contract and say, I'm borrowing £100 and I promise to pay it back in maybe a year's time with interest on top. Bonds are essentially the same. They work on the same principle, except that these are created by companies and governments around the world because they too need to borrow money to sometimes invest, sometimes just to manage all their bills. So for a government, their bills are usually the welfare state or building new infrastructure like roads, railways, airports, that kind of thing. And they borrow money for that. Companies, similarly, they borrow money to either build new factories or open up a new branch or expand into a different region or create new products. Shares, essentially what they say on the tin, it's getting a share of a company, a slice of a company and its future profitability, and therefore being able to participate in any money that it will pay out to you as a shareholder, usually in the form of dividends. Then you have property, and then you have alternatives. Alternatives are your more kind of niche sectors or products. These tend to be sometimes more risky, but therefore, because you're taking on more risk, you expect a higher return. And then the market is also divided by sector. So this is pretty straightforward. You have various sectors from retail. So think of your BHS, think of your House of Fraser, which has been in the news today because it's struggling. Think of your M&S. Aviation and transportation, this is your Virgin, this is your BA, this is your Qantas, or this is your Rolls Royce, this is your what are the names? Volkswagen, General Motors, that type of thing. Construction, again, similar. These are like usually your massive property construction firms that build both commercial and residential property. We actually had a famous example recently this year when one of them went under, called Carillion. And then you have pharma and healthcare. So this is your Procter & Gamble. This is your GlaxoSmithKline. So basically, when you buy like paracetamol, that kind of thing, just check the name on the back. Usually, these companies, the producers are quite huge companies. Then you have industrials. These are the kind of people that produce chemicals. You have oil and gas. People like your Halliburton, your BP, your Petrobras. That's the Brazilian one. Or your Saudi, which is the biggest one, Saudi Aramco. You don't have metals and mining, so these are people that produce things like your copper that goes into wiring, or even those that produce gold or diamonds. So examples are Rio Tinto, Xstrata, De Beers. Technology, most common one or the most well-known ones go by the acronym of FANG. So that's Facebook, Apple, Amazon, Netflix, and Google, or Alphabet, as they're known as. And then financial services. So these are your massive investment banks, your banks. So Barclays, RBS, Goldman Sachs, JP Morgan, those kind of people UBS. So here is a map of how it all looks like. So as I said, we are split into geographies. You can see starting on the left-hand side in the top-hand corner, you have North America, then you have Latin America, and then coming towards the middle, you have EMEA. So they all group together, and then you have Asia Pacific and China. That's what APAC stands for, Asia Pacific and China. And then within these regions, you will have further segmentation. So you might have Europe, or in Asia, you have Asia excluding Japan or China, or Asia excluding Australia. And then North America, you might have just the US. Latin America, you might have just Brazil, or sometimes even places like Chile where there's a lot of mining. So this is how, when you go out there and start investing, you will see the products listed by. They'll be listed according to, or given a name according to the region where the money is invested. So what should you be aware of in terms of keywords? Is this all making sense so far, by the way?
Yeah.
Cool. So the first keyword that you need to know about is risk. Nick, can you just explain what risk is?
So risk is uncertainty around your investments. So it's the potential that your investments may go down as well as go up. So as I was giving you the example of House of Fraser. So House of Fraser are currently going through a bit of turmoil at the moment. So that risk could have an impact on the value of House of Fraser. So as I was saying, some people are risk averse. Risk averse is where they don't like risk. Any uncertainty will put them off investing in products. Where you might be a risk lover, where the information on House of Fraser at the moment will not put you off investing in it. So you will go ahead and put money in House of Fraser, hoping that the returns will be greater. So that brings us on to returns. So return is the amount of money that you make, or even loss or lose rather. So if you've invested £10 in House of Fraser and House of Fraser has gone up to £20, just in simple terms, forgetting about any transaction costs, you've made a £10 return, excluding transaction costs. And then we move on to capital. Capital is a term of describing assets or value. So in finance, this could be as simple as the money in your bank, the house that you live in, if you're a homeowner, the company that you own. So if you are a small business and you own your own company, that is capital in itself. And then you have capital allocation, which is how you allocate that capital. So as we've talked about in previous topics, we have diversification. So where I talk about diversification is where you have your assets split across different asset classes. So you can have some of your money in shares, some of your money in bonds, some of your money in cash and property. So that's what we will say is a well-diversified portfolio, and that is you allocating your assets accordingly.
Cool. Thank you, Nick. So does that make sense to you guys so far? Essentially, risk is just the uncertainty around your investments, the potential for them to have a negative impact on your finances as opposed to your positive impact. Return is just the money, is actually just quantifying the money that you make or lose. Your capital is what you're investing. Money that you've invested in a company, or you have in your bank account, or you have in property. And then asset allocation, as Nick has explained well aptly, is just splitting your money across all the different types of assets, or as many as possible. Adi, do you have a question?
Yeah, I was just going to ask in terms of risk lovers versus people who are risk adverse.
Mm-hmm.
With the example that you've given today, or in general, there are many examples of companies who have been in turmoil, like the example you've given today, who have made a swift change, so that these kind of things might enable some people to be more kind of risk lovers if they've seen examples of huge turnarounds in companies.
Yeah, very good question. So number one, when we use the term risk level or risk averse. It's mainly to describe your appetite for risk, which will then affect the kind of products that you buy in the first place. I'm just saying this for the benefit of all the attendees. And usually what that then means, so for example, if you're a risk lover, you will have a greater proportion of your money in shares in the stock market. Whereas if you're a risk adverse, you will have maybe more in bonds, or which are usually thought of as less risky. And then if you're somewhere in the middle, you have a good mix. In terms of what you've asked, Ade, usually the way to kind of think about it in terms of which companies might be struggling or maybe perhaps advantageous to get into if you think they're going to recover, is to start with the bigger picture, which is what we call the macro picture, and look at the economy and how well it's performing. So to give you a practical example of this is the oil industry. The oil industry is very volatile because there is a lot of players in the market, and the value of these companies is very much dependent on the price of oil. So, for example, you might have noticed in the last few weeks that what you're paying now at the pumps has gone up a little bit. That's because they're essentially, even though there's a lot of players, they are limiting the amount of oil that they're producing. So that's what we call, so you've heard of OPEC. This is a coalition of different countries that produce oil. And sometimes what they do is that they will intentionally stop producing oil to force up the price. However, when that happens, more players enter the market, especially in somewhere like the US, where they also have a lot of oil. Because now, when the price goes up, it's more, it makes more sense from an investment point for them to produce oil. And by doing so, conversely, that then starts dragging the price of oil down. So in such situations, that's where you can get a lot of volatility in the stock price of oil companies. And it's very dependent on the price of oil and how much they're producing. So you may notice when 1 week BP is doing very well, the next week it's down maybe 4 or 5%. That's just a quick example. Another way to look at it as well is the shift in terms of the economic standpoint, is to look at the shift in consumer behavior and consumer spending. Now, 10 years ago, you would happily walk onto the high street to buy your clothes and other stuff that you need. But now people are moving online more, especially our age group, as in the millennials, who are the ones that now have the spending power. Because of this shift, and this is what we call a demographic shift from old to young, and due to the change in habits, we're seeing a lot of the high street firms taking a battering. So today you had House of Fraser and you had Poundworld. A few weeks ago, you had Maplin, and I think before that you also had BHS, and even M&S has gone through its own turmoil. So you can see there is a changing, and this is no coincidence. If people are going online for their products because it's cheaper or it's more convenient to do so from the comfort of their own home, then these companies that haven't adapted to this change will struggle. Now, some people might see that as an opportunity to invest. Others might see it as a time to bail out. So it just depends on where you are and if you think that company has a future ahead of it or not. I hope that makes sense.
Yes, thank you very much.
Cool. Next slide. So this is where we get to the fun stuff. Asset classes.
So we've been discussing asset classes, but let's break it down to make a little bit more sense for you guys. So let's start from the beginning. What is an asset? So an asset is an economic resource, whether it be tangible or intangible, that can produce you value. So put it in simple terms, it can represent a value of ownership that you can easily convert into cash, of which cash itself is an asset. And cash is also known as one of the most liquid assets because cash is easily available. So as you see, so cash is made up of...
What's liquid?
So liquid is how quickly you can convert something into cash. But because cash is already liquid, you can spend it. So let me give you a better example. So if you're a homeowner, which is a part of real estate, which I'll discuss in a bit, but if you're a homeowner and you need money tomorrow, you can't sell your house tomorrow. Therefore, it will be known as illiquid. So although your house is an asset, because you cannot sell it as you need it, we will class that as an illiquid asset. So as I was saying, so cash that's your most liquid form. Then you have your money market goods. So money market is mainly used by, as I said, the banks and governments. So banks will lend. So for example, you have HSBC lending to NatWest. They will lend to each other daily at a specific interest rate and for a given amount of time. Money market products are usually, you can actually go up to a month, but usually no more than, say, a week that they're lending to each other. And then you have bonds. So a bond is a debt. So a bond, think of a debt is an IOU. So bonds could be issued by governments and companies. So what it is, so say if you're a government, so the government, they got to raise revenue. The only way the government can raise revenue is by taxing us, so taxing you and me through our pay, or through the bond market. So what the government says, they will say, I will lend you £100 for, say, for 10 years. And what they'll do, they will pay you a fixed coupon at each period. So you can have a semi-annual bond. So that means you get 2 payments a year. You can have an annual bond, which you get the 1 payment a year, or you can have a quarterly bond where you get payment every quarter. But there's a good question. What this government bonds or bonds in general are known as fixed income. So the reason why this is known as fixed income is because of the fact that your payments are fixed. So every 6 months or every quarter or every year, you're getting this payment from the government or a company at the given time. Equities is another asset class. We was talking earlier about House of Fraser and other companies that are on the high street. These companies, what they do to raise revenue, they sell their company to the public. So they'll issue an IPO. So they'll go to a exchange, issue an IPO, so that then they can raise revenues. What they're essentially doing, they're essentially selling their company to the public. So the everyday person, me and you can get in touch with a broker to purchase some of these shares of that company. And as in that, what happens with the shares of company is affected by different news, how well the company's doing, if it's making profits, etc. And it gives you ownership. So if you own enough shares, you could be in a strong enough position to have your say in board meetings. Because what happens is you're essentially owning the company. So for example, say Economic Street, years down the line, me and Olo are in a position where we want the public to hold some of our money, own our company essentially, because we want to raise revenue. It gets to a point where at the moment, me and Olo are the shareholders at the moment, but if we was to raise our money on the exchange, publicly, the everyday person could then purchase Economic Street shares, and they can have a say in how Economic Street runs to a certain extent. Obviously, you still have the board of directors, etc. Real estate, which can be commercial or residential, that's just owning property. You can own your home, which is residential property, but then you can then use your home to then purchase other properties and have a little commercial empire. Or you can have buy, say, shops and have a property that way. So there's different avenues you can have with real estate. Commodities is, as Ola was giving you the example, Ade, of oil, copper, gold, silver. These are stuff that you can buy on the market, and they're highly, some of them, as in the case of oil, highly volatile asset classes with the price fluctuating quite dramatically. But another commodity that's a bit more safe is gold, which is known as a safe haven due to how in the past gold was known as the gold standard. If there's any issues in the economy, people tended to harvest gold and purchase gold as a little safe haven. And then you have a bit of the alternatives. So the alternatives are private equity and hedge funds. So with your hedge funds, these are, when we talk about risk added, these are like, hedge funds are more for people that are risk lovers. Because hedge funds will, what their aim is to do is to give you greater returns than the market. So what you're doing a hedge fund, you're often invested in highly risky products, but what you're supposed to get in return is a bigger return than, say, just invested in shares. So there's the risk and return of investing in hedge funds. And you have private equity, which are where firms, what they do, they'll buy. So, for example, House of Fraser at the moment, some people may say it's a stressed company at the moment. So what you may have is high net worth people will purchase these struggling companies, and then what they will do is pump in and fix the company up and get it back to a certain level, and then sell it on for greater value than they purchased that company.
Cool. Thank you, Nick. So does that all make sense so far? We are actually going to be breaking all this down over the next couple of sessions as well. So we're not going to cover all this today, but we just wanted to give you an overview of the investment landscape on all the different products that you can actually buy as an investor. So cool. So yeah, cash, money market, bonds, equity, real estate, commodities, and alternatives. Those are your main asset classes. And it's basically split between, you can see like 2 and 3 are basically types of debt. Then you move on to share, which is an equity. And then you move on to your tangibles, which is your real estate, your property, and then alternatives. For each class, you have different expectation of risk or level of risk, and therefore a different expectation of return. So let's have a look closely at the money market, but Nick has touched on this well already. So we'll just go through it quickly. Money market instruments are just short-term loans made to companies. It's usually mainly banks lending to other banks, because banks sometimes they run into short-term lending issues. So they need to raise money quickly, because a bank is a business at the end of the day. And governments also make use of this. You can invest into these loans as part of your investment portfolio directly or indirectly through what we call mutual funds. And we'll cover that as well next week. So the reason you can invest in these is because essentially these banks and governments are borrowing from you and other companies who have money. So it's an investment in the sense that you can generate a return on it. Common examples are the Treasury bill. You get this in America. You also have commercial paper. Nick, what is a commercial paper?
So commercial paper is a short-term borrowing between, again, mainly governments issue commercial papers, but you can also have firms issuing commercial papers. Basically, it's a short-term loan. So commercial papers are usually between a day and a week that you can that firms or governments will distribute a very short-term income.
Lovely, thank you. Key features, which Nick has already explained. Coupon. So a coupon is basically the interest that you earn over time. So whether that be over a quarter or a month or a year. Yield is the total return that you make. So there's a nuance here between coupon and yield. Coupon is the interest that you will see that the government or the company attaches to the money market instrument. The yield is actually what you make, because what you have to remember is that these products are tradable. You can buy it and sell it at any time. And because you're doing this and other people are doing it, the price of these things change, which then affect the total return. So I'll give you an example. Let's say the government wants to borrow £100 and pay you £5 in interest. But then it costs, so in total, what you will receive back is £105. However, if we now say that you're not buying it directly off the government anymore, but you're buying it in the marketplace, and the price has gone up to £101, that means your return is now only £4, the difference between 105 and 101. So that's what yield means. Yield is the actual return. Coupon is the interest. The coupon never changes. It's always that £5, but your return can be more than the coupon or less. So again, if the money market is now being sold for £90 rather than 100, and you know you're getting £105 back at the end of the day, you're making more than the coupon. So this is where the whole issue of supply and demand comes into it. Price is what I've just said. The price of the instrument or the asset can change from day to day. And then maturity date is simply when the debt has to be paid back. The government has to pay you back your money, whether that be in a week's time or a month's time or in a year's time. Bonds, IOU. So this is just a refresh. Companies or governments can borrow money and they promise to pay it back at some time in the future with an interest. This has pretty much the same features as a money market, with the added aspect of the fact that it's usually for longer. It's usually over long term. So you can get 5-year, 10-year, 15 years, up to 30 years usually. And you as an individual can invest in these. So the types, corporate bonds. So these are the ones that companies issue, and you can invest in them. Government bonds. These have various names depending on the country. So in the UK, we call them gilts. In America, they're called treasury bills or treasuries. And in Germany, they're called bunds. Government bonds are known as risk-free. What we mean by that is, remember, a government is borrowing on behalf of the citizens. So in this country, there's 65 people in the population. Those people are all going to be taxpayers at some point in their life. So basically, that is what the government is being backed by. They're being backed essentially by the fact that they have a population that they're borrowing on behalf of, who at some point in their life are going to pay taxes and can pay back this money that they're borrowing. So that's usually why a government bond is known as risk-free, and other assets, so from shares to commodities, are priced against these. They're used as the benchmark. In essence, nothing is risk-free, but that is the terminology associated with government bonds. Municipal, these are more common in America. These are like almost like county or regional bonds. It's like maybe the city of Birmingham issues a bond, or the city of Sheffield or Manchester issues a bond. Benefits, they're less risky. Bonds are, you receive an income known as a coupon, and if the company or the so if a company is going bankrupt, that is issued a bond, usually as a bondholder, you're one of the first people to receive your money back, which is a great benefit. Key features, the coupon, the yield, the actual return you make, and then redemption or the maturity date, the date your original investment has to be repaid, plus the final coupon. So we're just going to have a quick test your knowledge round. First question. What is the name given to a UK government bond? I've made a mistake. That should be gilts flashing. Government bonds issued in a foreign currency are called foreign bonds, exotic bonds, or Euro bonds. What do you think? So this one is actually called Eurobonds. It's not intuitive, but usually for example, let's say the government of Nigeria wants to issue bonds in dollars. It will be called a Eurobond. Why? You may think, why would a government issue bonds in a currency different to theirs? Well, given the example of Nigeria, the currency can be very volatile. That puts off a lot of investors, especially those that live internationally. It's like you taking your pounds now and saying you want to buy a bond in Nigeria that is denominated in Naira. By the time you've got your money and the interest back, it may be worthless because the price of the currency is moving so much. So to attract investors, because they still need to raise money, they issue these Euro bonds. Final question, US government bonds are risk-free because, and you can select the ones that you think apply. What do you think, Adi?
I would go for A and maybe C. Can you tick multiple?
Yeah.
I would say A and C.
Okay.
I don't know.
Very, very close. It's all of them.
Okay, cool.
It's all of them. So the US government, I think, are one of the few, if not the only one, that has never defaulted officially on its debt. So yeah, all three apply. Third.
Sorry, can I just ask a question? Is this where you get governments with this? Is it triple star ratings and all of this? Is that what it is?
Exactly.
Okay.
Very, very good point. So that's something we're going to mention in other sessions. Is basically all these products are rated. So usually bonds will be rated according to how creditworthy or the level of confidence investors have in that country based on a number of factors. So usually you will see countries in the West have the best bond ratings, and then countries with maybe political instability or dictatorships or economic crisis have some of the worst bond ratings. So like Venezuela has been in an economic crisis for about a couple of years now, so their bonds are not rated highly. Argentina has had problems once upon a time, and a lot of countries in Africa as well. So yeah, all three. So shares, they are also known as equity or stock, and essentially they just give you part ownership in a company. The more stock you acquire in a given company, the more control you have through what is called voting rights. So these shares usually have what is called voting rights attached to them, which give you as a shareholder, which is what you're known as, the opportunity to take part in company decisions. So yeah, you have rights as an owner. Benefits of this: you participate in company decisions through voting rights, including decisions on who they appoint as directors and pay packages, which can be very controversial. We saw a lot of this during the financial recession. A lot of the bank CEOs were getting a lot of stick because they had huge compensation packages, and it just, because of the political climate at the time when they were being blamed for what happened, it was very negative. It reflected negatively on companies if they paid such huge pay packages to these directors. Other benefits include the fact that you receive income periodically, which we know as dividends. This can be quarterly or twice a year or annually. You obtain profits if you sell your shares for more than you bought them. So this is known as capital gains. Key features of shares. Usually publicly listed companies are listed on what is called a stock exchange. Nick, do you want to explain what a stock exchange is?
So, a stock exchange, so the role of a stock exchange is to help bring companies to the market. When I mean to the market, to the general public. So, for example, the London Stock Exchange, as I was saying earlier, companies who are privately owned will, using an investment bank, get their shares issued on an exchange so that people can then freely buy and sell shares in that company. So, basically, the exchange is there to facilitate firms going public and being able to raise capital by selling ownership of their company to the general public. So examples of that, say you've got the London Stock Exchange in the UK, you've got the Nasdaq in the US, you've got Deutsche Börse in Germany. So these are, and then you've got the Tokyo Stock Exchange. So these are stock exchanges that are around the world where you can then get in contact to buy and sell different shares and assets, or shares, sorry, not all assets.
Cool, thank you. So LSE is the London Stock Exchange here in London. NYSE is the New York Stock Exchange, and Nasdaq is a similar one in America as well. A stock index. This is a measurement for a collection of stocks. So, for example, you have the FTSE 100, which represents the largest 100 companies in the UK, or the S&P 500, which represents the largest 500 US companies.
And I just want to quickly, apologies to interrupt, just a quick one with the FTSE 100. The FTSE 100 is a little misleading also, is because it's the 100 largest in the UK. However, that's also made up of foreign firms. So a better measurement to see how well the UK is doing, or if you want to say track true UK investment, would be to say like the FTSE 250, which is another index, another type of index which truly tracks UK companies. Because the FTSE 100, because firms internationally can list in London as well. So basically what I mean by that, international firms. So for example, Facebook didn't, or for example, Facebook, if they wanted to, they could have listed, when they went public, they could have listed in London, and it made it easier for us to buy and sell their shares. So the FTSE 250 would be a true representation of the 100 companies in the UK, where the S&P 500, for example, because the US is so big and have so many companies, that is a true representation of 500 companies in the US.
Yeah. So when you hear these indices touted on the news or in media, the reason that they refer to them is because they're used as a benchmark for how well the economy of that country is doing. It's an indicator, or almost like a reference point, starting point. So that's why, though they don't give the entire picture, people like to start with them because they're a good representation of the direction that country is going in terms of its economy, and therefore if it's going to continue to perform as an investment destination. Designations of shares. So usually if you buy a share, they'll have a designation. Some are called ordinary, some are called preference shares. And these entitle you to different types of rights. So maybe if the company was to go under, for example, preference shares may entitle you to receive part of your money back before ordinary shareholders. And also they have different, preference shareholders sometimes also receive dividends before ordinary shareholders. Classification again. Classification of shares tend to get Class A and Class B shares. That's the general one. Reason for this again is they have different rights attached. So maybe, Ade, for example, if you were to invest in Facebook and you buy Class A shares, you will get two voting rights for each share you own. But if you bought Class B, you only get one voting right. So that's sometimes why they use different classifications. Anything to add at that point, Nick?
Also, it could be due with the amount of dividends you receive as well.
Yeah.
So dividends, as we always talk about, is how much you get when the company's done well and made profits. They want to issue dividends to their shareholders. So it's the way you receiving money. With preference shares, they may give or different holders different shares. So, for example, if you only own Class A shares, you'll get, say, a £1 dividend. Where if you're a Class B shareholder, you might get a special dividend of £2. So, as well as voting rights, it can give you dividends as well.
Lovely. Bid ask spread. So usually when you buy a share, you will see two prices listed next to the name of the company. One is called a bid price, one is called the ask price. Why do they do this? Because essentially you're going to be able to buy at one price, which is usually the higher of the two figures quoted, and you're going to be able to sell at the lower of the two prices. And the difference between those two prices is what is called the spread. And this is where a stockbroker or the person you buy your shares through, that's what they're making. So a good point would be, for example, if you now bought shares in Apple and each share is £50, as soon as you bought those shares, you will see, and you check your account, the price that will now appear next to your account and your share will be £49. That's because, remember, you're able to sell the share now at a lower price, and that means usually you have to hold the shares for a little while before the price goes above your original investment and you're able to make money on it. PLC is just an acronym for Public Limited Company. Usually this is carried by companies that are public. And then bear and bull market. This is a phrase used in the investment world that denotes the fact whether the market is doing well, and if so, it's called a bull market, and if it's doing poorly, which is a bear market. And you can see by the two, the bull and the bear on the right hand side of your screen, denoting this. The bull is a lot more powerful than the bear. Yep. Question. How quick can you sell a share after they buy it? Yeah, usually straight away. But then that just comes back to the fact that we just mentioned. As soon as you bought a share for £50, the price that now appears next to it is £49. So if you sell straight away, you'll be making a loss. But the ability to do so is there straight away, as long as it's done during when the market is open. So this raises a good point actually. The market usually operates between a certain time frame during each business day. I think it's between 9 to 4:30 here in the UK. And that's the time where you can place orders to buy and sell shares. Outside of those times, you can leave requests to buy and share and sell. But it's only when the market then opens on the next business day that trade will be executed on your behalf.
I just wanted to ask a quick one, but Ola's going to give you a little scenario next at it anyway. But also, when you're buying and selling that quick, bear in mind transaction costs. So if you're going to buy and sell that quick, which you can, but don't forget each time you're buying and selling, you're incurring a transaction cost when you're doing that. So, but probably we've got a little scenario now that we're going to go through to explain in a little more detail.
Thank you.
So let's imagine that you invest £10 in Apple shares and your broker charges you £12 to make this investment. In 12 months' time, those shares are now worth £20 and you decide to sell, and the broker charges you £12 to sell your shares. How much have you made? If any.
So just to be clear, the broker has charged another £12.
Yeah.
When you're selling it.
Yes.
That's correct. So £12 each time when you've purchased and then when you've sold.
Yeah,
I almost feel like you're making a loss, but I'm not too sure. I think Demi says
you're right.
nothing.
So Demi said nothing. You said you're making a loss. Well, let's break it down. So you buy the shares first for £10, and you've also charged £12. So in total, you've just spent £22 to buy shares. In 12 months, you sell them for £20, but then you have to pay another £12. So you spent £22, you made 20, so you're down £2. Plus, you've just been charged another £12. So in total, you're actually down £14. So you've lost money. And therefore, this is why it's very important to, and it comes back to what we said in the beginning about having an investment objective, number one, and having a time horizon over which you want to sell. So in that case, if you're selling in 12 months' time, you're actually losing money. And that's why we say it's important for you to include the broker fees and any other fee involved in buying or selling shares in order to then work out the total amount of money that you're going to make from that transaction. In this instance, that might mean you decide not to sell and you hold for longer to see if the shares go up in value even more. Or if you think the future is bleak for Apple, you may just decide to cut your losses short. So sometimes there's actually nothing wrong in selling at a loss if you don't think, or if your expectation for that company now changes. And that's why usually with that icon, the infographic, you can see buy, sell, or hold. Those are decisions that usually an investor is confronted with when it comes to their portfolio, whether to buy more, sell what they currently have, or just hold and play it out. So yeah, just a note again, just pay attention to the bid-ask spread, because again, that is a type of cost that you're incurring. The fact that you can buy you're buying at a higher price and then you're selling at a lower price. So yeah, let's test your knowledge. Is buying shares directly from a stock exchange possible? Do we have an answer?
And he's gone for C.
Okay. So the answer is no. Back in the day, usually you could, but now, because everything is digital, you need an investment broker who then has access to the stock exchange. So an investment broker is usually a company that represents you, almost like an agent in football would. And they then go and buy the shares on the stock exchange. Next question. The acronym LSE stands for the London School of Economics, the London Stock Exchange, or the London Stocks and Brokerage Exchange. Cool. B. Final question. What is another phrase for a company's market value? Market capitalization, investment value, or intrinsic value? A, B, or C? Any idea? So this one is A. So again, in the news, if you watch business news or read financial news, they refer to a company's market value as its market capitalization. That just essentially means all its shares multiplied by the price of each share or the value of each share gives you the total value of the company or the company's market value. So for example, I think is it Apple? Is Apple around 500 billion? So some of them are, yeah, it's quite high. So yeah, and then they'll just say market cap next to them. So let's start looking at the investment process. What does it entail? You'll need a broker, and we can see what these look like in a minute. You'll need to decide how much you want to invest. You'll need to do some research reports, read like research reports or use recommended lists, and also use asset allocation tools, which we'll look at in session 3. And then finally, monitor your investment. It's important, especially in this day and age, to be very active in managing your money. So what do we mean by that? It's not enough to just say, I'm going to leave my investment for 6 months, for a year, for 2 years, not have a look at them and not know what's going on. You have to play an active role in that process and making sure that your investments are safeguarded. By safeguarding, we mean, is it time to bail out? Is it time to invest some more? Or is it time just to keep holding on and just riding it out? And the reason you're doing this is just, it's a constant reevaluation, because you want to understand if your money can be working better for you or making more money for yourself. And so that's why this 5-step process is very important. The reason you use asset allocation tools in number 4 is because you want to determine how much of your money you're putting in each asset class. And that usually is a reflection of your appetite for risk. So let's say you have £1,000 to invest and you're a risk lover. You may, through an asset allocation tool, decide to put 60% of £1,000 in shares in the stock market and the rest in bonds. Or you may say 50% in shares, 40 in bonds, 10 in money markets and alternatives, that kind of thing. So this is where asset allocation tools are really useful, just to get a good top level picture as to what you should be doing or what you would like to do with your money to achieve the objective that you set for yourself at the start of the process. Research, yes, question. Can you pay someone to watch your shares for you? Thinking of busy people. Yeah, you can. So it depends on the kind of broker you go for. There are some, different brokers perform different activities for you. Discretionary brokers will act on your behalf and take decisions for you. Execution-only brokers will literally just take your instruction to buy or sell, and that's it. Obviously, depending on the type that you go for, will also affect the fees that you pay, or the amount of fees that you pay. Cool. Going to pause it there quickly, and we're going to have a look at a broker. Okay, so this is where you can locate can you all hear me, by the way?
Yeah.
Cool. This is where can you see my screen?
Yeah.
Cool. So this is where you can locate a broker. The London Stock Exchange actually has a list of approved brokers, and you can actually search by the type of function that you want them to perform. So this comes back to whether they're execution only or advisory or discretionary. And you can see a key down here that explains what they do. So execution only brokers will solely buy or sell shares according to your instructions and provide no advice whatsoever. Advisory brokers will provide advice and also execute. And discretionary brokers, so these are the ones that will actually keep an eye on things and act or make decisions without prior approval. And so depending on what you want to do, you can then go through this list and filter it and find the one that best suits your needs at a. Cool. We'll actually be looking at an example of a broker next week in next session. So you definitely want to stay tuned for that. But for now, this is the end. And any questions?
No, not for me.
Okay. Demi, how about you? Anything that you want to ask based on today's session? Okay. No problem. On that note, we're going to end this. We're going to be resuming next week on Monday from 7:30